Hello and welcome to Sectors Up Close. I'm David Pollard. Today we're looking at the stresses and distresses of Europe's car makers with Joachim Klement, Head of Strategy at Panmure Liberum. Ever thought you'd like to own one of these, a Porsche, status symbol for so many financial market professionals? The car, that is, not the shares, which are down over 20% on the year, a figure even worse than the 15% drop in Europe's Stock 600 automobiles index, amid countless profit warnings from the sector, the threats of Chinese competition and now tariffs from the United States, soon to be under Donald Trump. Well, welcome, Joachim. Let's start with those tariffs. Do they mean potentially a much bumpier road for the industry ahead?
Yes, in particular for European car makers. A lot of them have factories in the US that will not be subject to tariffs, but the suppliers and some of the supplies might come from Europe and Asia, particularly China, where the tariffs might be even higher than anything that would be levied on Europe.
Let's look at China. It is, of course, the world's largest car market. All the profits warnings that we've been seeing from the industry over the last few months have mentioned China pretty much. That's from BMW, VW, Mercedes, all of them talking about China. What can Europe's car industry do about China? Can they just hope that it's going to get better there, or do they have to look elsewhere?
The Chinese government is still reluctant to add a lot of fiscal stimulus to create additional consumer demand. And as long as that is the case, Chinese sales numbers will remain weak. Where would you get other markets? Well, that's a really difficult thing, because normally you would look to Europe itself, which is getting better, and sales numbers are improving there slightly, but Europe remains a low growth saturated market, just like the US, which means that for now, most car makers have to basically sit there and wait for China to come back.
Now, China, of course, is also the world's largest EV maker. What can European car makers do about that? Are they losing the race into EVs?
When it comes to the EV market, Tesla, together with a lot of the Chinese manufacturers, are technologically far more advanced than the US or European car manufacturers. And the right way to deal with this challenge from these relative newcomers is to invest more heavily in research and development of electric vehicles, which at the moment, given the lack of free cash flows and the lack of sales growth, the European car makers in particular are cutting back on those developments, and that in the long run is not a good way to deal with it.
And in that respect, VW, of course, has figured very large. It's been at loggerheads with its unions over possible cutbacks at some of its plants. Is it the right way for a huge company like VW to go?
Well, being German, I followed the German press and the reaction to that announcement in Germany, and it was a real national shock. Is it the right way to do that? I would say yes, it is, because VW, just like many other German car manufacturers, needs to save costs in the right places. And that means saving costs in obsolete or outdated technologies like internal combustion engine cars, and investing more in future technologies like EV, which usually happens in China or in the US, not in Germany.
So how do we view the car industry on a global scale? Is this an industry that has had its best day, at least in its current form? Where do you see it going in the next 10, 20 years from here?
I think it is a major transition that the car industry is going through, switching from internal combustion engines to electric vehicles and potentially fuel cell vehicles based on hydrogen. And just like with any industry that goes through these massive changes, there's a long period of consolidation where some older players will become obsolete. Just think of the transition from old-fashioned film cameras to digital cameras, which famously was the demise of Eastman Kodak. And the world is full of these illustrations. The shift from PCs to mobile phones, which meant that for 20 years Microsoft was really not a good investment. But eventually we will come through this, and I am confident that European car makers, and in particular the German premium brands, will reinvent themselves and will make it through. But it will take time, 5 years, possibly longer, before they can come out at the other end.
So what does that mean for investors in this sector? Is now a moment to get into European car makers? We've seen car maker shares in Europe, they're down around 30% from their peak in April. So is this a good moment?
Well, when I was managing money in the past and talked to other fund managers, the wisdom was always you buy car makers at a high price to earnings ratio, not a low price to earnings ratio, simply because earnings are so much more volatile than the share price itself that you want to invest when earnings are on a cyclical low. And you might argue that we're there already, but I would counter that as long as we don't see signs of a recovery in demand from China, earnings will not have a viable path towards a recovery. And so I would, at this point in time, be still in a wait-and-see mode until I see clear signs that China's demand is coming back.
Okay, Joachim Klement, Head of Strategy at Panmure Liberum, many thanks for sharing your thoughts with us today. And that is your roundup of the European car sector. I'm David Pollard. This is Reuters.